AI rally unwinds, inflation set to cool in India, and my take on Netflix. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. When it rains, it pours, ladies and gentlemen, and that's exactly how investors who have propelled the AI trade must have really felt in the week gone by. When the most popular trade of the year, I've been telling you multiple times, AI trade, nothing's been stopping the AI trade. It couldn't be stopped by the Fed, couldn't be stopped by even President Trump. And the most popular trade of the year actually quickly unraveled, taking the entire market down with it. Once the dust had settled on a week where the bears completely dominated, all three indices firmly ended in the red. When is the last time I told you? It's been green, 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 green. Completely. Wheels came off in the week gone by. All three indices firmly ended in the red. Dow down 1.2%, S&P 500 down 1.6%, and the tech-heavy NASDAQ plunging 3%. And it was the worst week for NASDAQ since 2018. That's how bad things were. So let me quickly welcome you to the Doctor's Weekly Snap. There are lots to talk about, and I'll take you through the unraveling of the AI trade that took place in the week gone by. Put simply, it's not the Fed or the US economic uncertainty that punched a hole in the AI trade finally. It's valuation worries. So AI trade kind of, it was basically, I call it a self-fulfilling prophecy because even in the build-up, everything has been always about valuation concerns, valuation concerns, valuation concerns. Well, you know what? At some point, it became an actual concern, and that some point was last week. So it's essentially valuation concerns, is exactly what led to the unraveling of the AI trade, so to speak. More specifically, investors apparently got the sudden realization. I don't know where this realization was weeks ago when valuations were still stretched. 2 weeks ago, still stretched. 3 weeks ago, still stretched. Last month, still stretched. October was an amazing month. Normally it isn't. But defied history, defied gravity, nose bleeding levels. At that point in time, valuations were not a concern. But now, suddenly valuations have become concern. And they realize, investors realize that they might have driven up the tech names to nosebleed levels. Oh, wow. It's a brand new information, yeah? To understand why I keep saying volatility is the name of the game, all you can do is quickly, all you've got to do is look at how quickly investor sentiment has soared towards the massive capex spending investments by AI companies. At one point, it was all about more the spending, higher the stock went up. That thesis fully came to a complete standstill last week, as evidenced, by all the last week's action in the markets. There are now doubts. Again, I don't know where these doubts were last week or 2 weeks. Sorry, I don't know where these doubts were 2 weeks ago, 3 weeks ago, or even a month ago. But there are now doubts creeping up in investors' minds about the ability of tech firms to monetize the vast sums that are being spent on AI. Dr. Michael Berry of Big Short fame. If you haven't watched the movie, please go for it. And if you have watched the movie, this is the character played by Christian Bale. So I almost said Gareth Bale. He's a footballer. Always get it confused. But character played by Christian Bale is Dr. Michael Berry of Big Short fame. Also had a hand to play in the week's sell-off when he announced during the week that he made bearish bets against high-flying AI stocks such as the likes of NVIDIA and Palantir. There are also concerns surrounding big tech. The big tech companies are now resorting to debt to fund their AI investments. Never a good thing when you hear the word debt, which has also led to the negative reaction. The likes of Alphabet and Meta, Facebook parent Meta, have announced bond sales to fund their capex investments. Meta is doing nearly 30 billion. Alphabet announced about 3 billion, and this has not gone down well with investors who are now concerned that free cash flows and margins might stay under pressure for longer than initially expected. Obviously, when you fund it with debt, interest payments come into the picture. It's a whole lot. Debt is never a good case. Take Oracle, for example. After surging well past $300 on news of record RPOs and deals with OpenAI, the stock has given all those gains and more. Remember when I covered Oracle, my price target was about 237. It's currently, and this is the time I think the stock was trading about 300 levels. I'd made the pitch of 237. It's now trading below 237. So not only has it hit the price target downwards, it's gone well beyond. So it's given up all its gains and more. And it's trading at those levels around the time when it reported its earnings. And the rationale, very simple. Oracle is expected to take on more debt and will have negative free cash flow going forward as it funds its AI investments. Like I told you last week, Meta also came under pressure because of potential free cash flow erosion. So its valuation concerns, margin pressure, negative free cash flows, all of this are contributing. It's not the economic. I mean, don't get me wrong, macroeconomic uncertainty continues to remain. Consumer sentiment was at a record low last week based on the latest data that was released last week. I know we are nearing the end of the government shutdown. At least that's why the futures are up around the time of this recording. But that doesn't change. Take no matter away. This has nothing to do with all of that. It's simply because the big tech, the AI unraveling has nothing to do with that. It's simply because of valuation concerns, margin pressures, free cash flow, negative free cash flow, all of that. Look, I completely agree with the valuation thesis. It is indeed stretched. That's why I said, where was this concern 2 weeks ago? Where was this concern last month? Don't know. The valuation is indeed stretched, make no mistake about it. Take Palantir, for instance. It had a solid quarterly performance, amazing numbers, posted great growth, all of that when it reported last week. But this is a stock that is currently trading at 256 times forward PE. Nope, that is not an error. I had to double check. There was no decimal point missing. Oh, my bad. There is an error. It's not 256. It's 246 times forward PE. So yeah, that is an error, but it's still 246. It's triple digits. It's not 24.6, any of that. It's 246. Why has it reached these levels? Because investors have been betting on the name that the company will grow into its valuation. Fundamentally, very strong company, don't get me wrong, but the valuation had gone too far, too fast, in my opinion. The company has delivered, like I said, the company delivered solid numbers every quarter, but in my opinion, 246 times forward PE is a bit of stretch, to say the least. The funny thing amidst all of this is that Palantir currently trades well above its 5-year average forward multiple, which itself is an outstanding 139 times forward PE. So yeah, 139 times forward PE was its 5-year average. That itself is, whoa, mind-blowing, astounding, nosebleed levels, all of that. But no, currently it trades at 246, so it's blown past even that astounding level of 139. Now you can clearly say valuation is not just at a stretch. You are now reaching insanity, levels of insanity, a territory where you know, investors, if they continue to keep pumping it up, I don't know. Personally, I would call it insanity. So yeah, if one looks at Palantir and then looks at the likes of Oracle, there is no doubt that valuation has reached stratospheric levels, and a pullback was inevitable, in my opinion. And it is healthy. The pullback, this inevitable pullback, so to say, is actually healthy. It's good. Finally, people are realizing that they're reaching nosebleed levels on select companies. Fundamentals might be great, but it's like it's run too fast, too fast. When it's pulls back, that's a great opportunity for long-term investors to get in. More on that in a bit. Where I differ from the market, though, so I agree with the market's thesis, valuation is stretched. Fine, agree with that. Give full kudos to investors for finally realizing this. Where I differ from the market view is the worry that AI spending may be too much. I don't know on what basis the market has reached this conclusion. I know you can say that companies are being dramatic when they say demand continues to outpace supply, but if one looks at the likes of Google, Amazon, Microsoft, and even Meta, then the key takeaway is that their AI investments are already paying off. The hyperscalers, let's take the hyperscalers, so Microsoft, Google, and Amazon, especially have seen very, very strong growth in their cloud revenues, primarily driven by AI. For the likes of Google and Meta and Amazon, AI has also propelled their ad revenues. AI-powered recommendation engines and targeting algorithms have led to significant increases in user engagements across platforms like Instagram, YouTube, and Facebook. For example, Meta reported a 5% increase in time spent on Facebook during Q3, directly attributed to improved AI-based recommendations. The more time users spend on platform apps, the greater the volume of ads companies can serve, which fuels further revenue growth for these companies. AI is also enabling these tech giants to consolidate control over the digital ad market, increasing with their market share expected to increase from 51% to 56% in just 2 years, something that would not have been possible without AI. When you look at the cloud backlog for the likes of Google and Microsoft, they're setting new records. They have surged, so they are not saying demand continues to outpace supply for the sake of saying it, for the sake of driving up their stock. So I have no idea what the issue is for the market if the tech giants spend to serve that demand. I don't know where the issue is. I don't know where the issue lies. You can post it in your comments and your own views. I'd love to hear your views on it. I just don't see the problem with AI companies spending. If they can spend for all valuation, I get it. I don't understand the spending, because if there is demand, surely you should spend to serve that demand, correct? So no, it's just, yeah. Listen, I understand the concerns surrounding, like I said, I understand the concerns surrounding valuations, margins, free cash flows. But this is a once in a generation opportunity for big tech to capitalize upon. The investments, like I said, are already starting to pay off for many of these names. And there is no evidence as things stand that would suggest that things would be different going forward. Do I believe that valuations are stretched? Yes. But do I believe that CapEx spending is an issue? Absolutely not. My view is that a lack of spending could mean a missed opportunity 5, 10 years from now. Like I said, last week, multiple times, AI, unlike the metaverse, is very much real, and the AI revolution is here to stay. As such, the sell-off we saw last week is nothing but a blessing, in my opinion. And I will be looking to add to my existing positions or even start new positions if this sell-off continues to persist. I already added to my meta position last week when it absolutely tumbled, needed that pullback, got the pullback, went in, pulled the trigger. Let's see, and any more pullback, I will continue to add. It's now my third biggest position already, and could very well be my second or first if the pullback continues to persist, because I do believe the long-term fundamentals are great. So Thanksgiving and Christmas, ladies and gentlemen, have certainly come very early for long-term investors. And in my view, you and I, should probably fully capitalize on it. On that note, we go from US to India. In our next segment, the doctor goes home, where actually things were really positive. Okay, so we've got some very positive news on the economic front in India last week. Now, while official October CPI data will be released only this Wednesday, so it'll be tomorrow, we did see some positive updates that indicate that inflation may have fallen further, actually, opening the doors for further rate cuts by RBI. More specifically, India's retail inflation for October 2025 is projected to have dropped to a multi-year low of 0.48% based on a Reuters poll of 42 economists. This would mark the lowest point in the current CPI series, 2012 base, that is. Remember, the government is changing the base of the inflation to 2024 to reflect more, to reflect a better understanding of the inflation picture, and I fully support. So, but based on the current CPI series, it would mark the lowest point. And the current series started way back in Jan 2015. Now, the drop in inflation has been helped by a recent cut in GST 2.0 reforms, something I've talked about multiple times. Food inflation, nearly half the CPI basket, also remains contained, attributed in part to favorable base effects, mirroring last year's spike in vegetable prices. Projections for October's data, like I said, scheduled to release on Wednesday, range from minus 0.21% to 2.1%. That's quite a broad range. Minus 2.1%, minus 0.21%, I don't expect to happen. 2.1%, maybe that also is a bit of stretch. Somewhere in the middle is what I would expect inflation to fall for October. Even at the highs, let's say assume it hits 2.1%, it would keep inflation well within the RBI's target range of 2 to 6%, which probably explain why many believe that the RBI will cut rates again at its meeting next month. To further support the thesis that food inflation has moderated, CRISIL Intelligence latest roti rice rate report, RRR report, not the movie, RRR report. And yes, this is a valid report. I'm not making it up when I say roti rice report. It is called the roti rice report. You have a problem with that? Please ask CRISIL Intelligence. But anyway, CRISIL Intelligence latest RRR report in October, the price of a vegetarian thali declined by 17% year over year, and a non-vegetarian thali, the price declined by 12% year over year, mainly due to steep falls in vegetable and pulse prices. The report found that potato prices, tomato prices, onion prices, pulse prices all saw massive declines, with onions and tomatoes seeing that prices plunging 51% year over year and 40% year over year, respectively. All in all, things do look very rosy as far as the inflation picture in India is concerned, which means that a further rate cut might be on its way, which would subsequently mean further economic growth. So happy days for Indian investors. And also, there are more happy news for Indian investors. We also got some positive picture on the earnings front. More specifically, India's corporate earnings for Q2 FY26 have already surpassed expectations, with the oil and gas, capital goods, and technology sectors driving the rebound. Nifty 50 earnings for the 27 companies reported so far have actually grown 5% year over year, propelled by the likes of HDFC Bank, Reliance Industries, TCS, JSW Steel, and Infosys. Margins expanded 170 basis points year over year, 1.7% year over year, and mid caps continue to outperform large caps and small caps, marking the fourth consecutive quarter of double-digit growth in this particular segment. FY26 Nifty EPS was also revised to 1,101 rupees from 1,096 rupees, just a 5 rupee bump. And FY27 EPS was revised to 1,278 rupees from 1,274 rupees, a 4 rupee upside, led by upgrades in the likes of HDFC Bank, Tata Steel, Ultratech Cement, Dr. Reddy's, Shriram Finance. While tariff uncertainties and global demand remain as key risks, the fact that the earnings cycle could be bottoming and growth set to accelerate, supported by domestic reforms, infra spending, and stable policies, both these factors would mean that the market momentum should keep going. Having said that, I do continue to believe that stock picking is the strategy to go rather than broad-based index investing, especially since broader markets overall are trading close to their long-term averages. All in all, yet another very positive week for the Indian economy and for the Indian markets. On that note, we're going to head straight to the final segment, Dr. Dissects, where I'm going to discuss one of my favorite names, which will go under the microscope this week, and that's none other than streaming giant Netflix, ticker symbol NFLX. Netflix reported the Q3 numbers a couple of weeks back, and with the exception of a one-time expense, which had a significant negative impact on the bottom line, overall, all in all, I think Netflix had a decent quarter, in my opinion. More specifically, Q3 revenues came in about 11.5 billion, up 17.2% year over year, in line with analyst estimates. Diluted EPS, however, came in at $5.87, and while this was up 9% year over year, it missed analyst estimates by a complete $1.10. Now, there is something to more to the story. It's not as suddenly Netflix is deteriorated. Okay, more on that in a bit. Operating margins also fell short of expectations, and the reason why EPS stumbled, operating margins stumbled, is because of a one-time tax issue in Brazil, which coming in at 28.2%, which translates to a 140 basis point or 1.4% decline, as well as a 590 basis point or 5.9% decline on a sequential basis. So this particular tax issue has led to an expense of 28.2%. So operating margins basically came in at 28.2% because of this one-time tax issue. Free cash flows, on the contrary, came in very strongly at $2.66 billion, up 21.5% year over year, and comfortably exceeding analyst expectations of $2.39 billion. At a time when negative free cash flow is worrying investors, Netflix held it very, very strong. As a result of this Brazilian tax dispute, which has led to this one-time tax expense, the company's guidance was mixed. More specifically, full-year revenues are now expected to come in at $45.1 billion, which would translate to a year-over-year growth of 17% on a constant currency basis. Operating margins, however, would now come in at 29%, marginally below the previous guidance of 29.5% on a constant currency basis. Let's move on to the takeaways. Now, ongoing Brazilian tax dispute, in my opinion, is not the main reason behind Netflix's 10% decline post the earnings release. By the way, Netflix announced a 10-for-1 stock split. So for those of you who think 1,100 is a bit of expensive, I think it's coming around this week, I believe, or next week, one of these days, Netflix's 10-for-1 stock split would be coming into effect. Price gets a lot cheaper. So that would, nothing happens to value. All I'm saying is firm value remains the same. Nothing changes. Don't get me wrong. But at least you get to buy it for $110 rather than 1,100 per share. So you can obviously go for fractional shares, but at least you get wholesome shares now for 110 prices. Nothing's changed on the value. Netflix valuation, no changes there. Let me be very, very clear on that. Now, coming back to the takeaway. During the earnings call, Netflix management clearly highlighted that this Brazilian tax dispute-related expense is a one-off expense, and the dispute is not Netflix-specific. As such, if the tax dispute was the primary reasoning behind the complete 10% decline, then this reaction to me is overdone. and other companies that are also in similar situation would need to be ready to see a similar reaction for this. Moreover, if actually one takes the tax dispute out of consideration, then overall it was a solid quarter of Netflix, like I said at the start of the segment. For instance, the company saw double-digit revenue growth across all its major geographies, and with the exception of APAC, Asia Pacific, the year-over-year revenue growth significantly increased across all other 3 regions. Furthermore, Netflix continues to deliver very strong content, as evidenced by the likes of Wednesday Season 2, 114 million views. Happy Gilmore 2, love the movie, 126 million views. In addition, the company's live sports continues to deliver with each passing quarter. The quarter was no different, with the Crawford versus Alvarez championship fight amassing more than 41 million viewers and hitting the #1 spot in over 30 countries. Finally, there's K-pop Demon Hunters. Haven't checked it out, but apparently that's all the rage, which has created such a storm and a fan following that it's now the streaming giant's most popular film ever, and it amounts to 325 million views. Finally, don't forget the company's Q4 slate, which appears to be even more promising, as evidenced by the much-awaited series finale of Stranger Things, coming to Netflix on November 27th. Season 9 of Selling Sunset, already done and dusted, if you haven't checked it out. Season 5 of Emily in Paris, can't wait for that. And Guillermo del Toro's Frankenstein, which has also now recently been released. A content slate that doesn't translate into healthy engagement is worthless. In Netflix's case, such a scenario has not occurred in recent times. Q3 continued to demonstrate this. The company saw record TV review share in Q3 in the US and UK, according to Nielsen and Barb data respectively, with the market share jumping 15% in the US and 22% in the UK. Finally, as further support that the Brazilian tax dispute would become an oversight in the future, the company's ads business is also showing tremendous growth. The company announced that it remains on track to double its ad revenue in 2025, albeit of a relatively small base. The company continues to innovate and forge strong partnerships to boost the ad segment. Based on current evidence, the move appears to be paying off. All things considered, Netflix missing its operating margins forecast and subsequently its bottom line estimates warrants a knee-jerk reaction. It got the knee-jerk reaction. But given that it's a one-off issue rather than a structural headwind, post-earnings reaction was overdone, in my opinion. To me, this reaction, the post-earnings reaction, and the subsequent weakness seen in the stock in recent times has nothing to do with this Brazilian tax dispute, one-off expense, whatever it is. In fact, to me, it has more to do with the news surrounding Warner Brothers Discovery, especially given the fact that the one-off tax issue will not have any material impact going forward. More specifically, the negativity surrounding, the Netflix stock could be closely associated with the rumors suggesting that the company would bid for Warner Brothers Discovery. Actually, already Paramount Sky has already made 3 bids, it's rebuffed, and there's a multitude of companies, and turns out Netflix is one of them, if rumors are to be believed, that could make a play for Warner Brothers Discovery. While these rumors were downplayed by Netflix executives during the earnings call, the fact that they were not dismissed outright further fueled the speculation, in my opinion. Now, Netflix has a track record of not getting dragged into bidding wars, a crucial reason why the company has not gone for outright sports rights deals like some of its peers, with Apple being the latest tying down F1's sporting rights in the US. During the earnings call, co-CEO Ted Sarandos mentioned how they have no interest in owning legacy media networks, so there's no change there, which suggests that Netflix may not make a bid for the whole company. However, that does not mean that the company cannot make a play for the company's studio and streaming assets, which includes HBO and HBO Max. So the critical question that Netflix investors then need to ask today, given the rumors, is does Netflix really need Warner Brothers Discovery? I have an answer to this question, and at least I have an opinion on this question. And for that, I modeled 4 potential scenarios in front of that are in front of Netflix with respect to Warner Brothers Discovery. Scenario number 1, Netflix acquires the whole of Warner Brothers Discovery. Scenario number 2, Netflix acquires the IP, the intellectual property rights of Warner Brothers Discovery. Scenario number 3, Netflix acquires the studio and streaming business or divisions of Warner Brothers Discovery. And scenario number 4, which is the baseline scenario, Netflix walks away from WBD and remains, and wants nothing to do with Warner Brothers. To analyze which of the scenarios creates the most value for Netflix investors, I deployed a deterministic pro forma model with fundamental analysis. The model calculates Netflix's standalone FY29 EPS by incorporating relevant growth drivers and then models the acquisition impact of each of the other three scenarios. Here's what the model results are. This time I already got the notebook and I already have written some notes already. Now, this is what the projected FY29 EPS would look under all four scenarios. Baseline scenario, Netflix walks away from WBD, has nothing to do with WBD. The projected EPS then stands at 31.3. You have a leverage of 1.3x. Okay, nothing, status quo. Projected EPS is 31.3. Scenario number one, acquires the whole of Warner Brothers Discovery. The projected EPS is 33.12, but the leverage is shot up to 4.1. EPS growth for certain, but leverage has gone up more than 3 times. That's scenario number one. Scenario number two, acquires WBD's IP rights or intellectual rights. The projected EPS for that is 31.27 with a leverage, potential leverage of 3x. So 1.3, it goes up to 3x. But actually, Netflix loses money in that way. 31.3 is the projected EPS there for a baseline. If it acquires IP rights, according to model estimates, it should be 31.27. So actually, you're losing money. So clearly, that's not happening. The best scenario, based on the model estimates, based on the model analysis, based on all the assumptions put in, is scenario number 3, which Netflix acquires WBD studio and streaming business, including HBO and HBO Max, and the DC Universe, which would give projected EPS of 37.94. And even though the leverage is, 3.2, there is a 6.64 incremental improvement in EPS in FY29. So according to the scenario, the best scenario is, according to the model, the best scenario is you acquire Netflix's studio and streaming assets. So essentially, that's what the model now comes in. Now, obviously, the question comes in, how did I get this 6.64? Is it just a random number I just posted? No. To examine how the acquisition of Warner Brothers Discovery Studio and Streaming Division, which is scenario 3, creates value for Netflix, I then conducted a waterfall analysis to understand the drivers and enable an incremental $6.64 of gain in the EPS relative to baseline scenario. This is what the waterfall analysis comes in. So let's say you acquired the studio and streaming business. You have the acquired EBITDA, which the incremental contribution is $2.69. Then you have the synergies realized, which comes out to be $5.16 of incremental gains. Obviously, you're going to fund it. Financing and dilution costs is going to be leverage. It's going to be debt involved. It's going to be, shares or shareholders will be diluted. So that it will have a negative impact on EPS. And that negative impact comes out to be negative 121. So you have 269 from acquired EBITDA, 516 from synergies realized, and negative 1.21 from financing costs and dilution. Total all that up, and you get an incremental gain of $6.64. So it's not random numbers that I posted. It is very much based on the these three elements three factors that contribute to the $6.64. Now, we come to the valuation point because you have two scenarios now. You have the baseline scenario, and you have the, let's say, under the scenario of acquiring Warner Brothers Discovery Studio and streaming assets. Now, according to Seeking Alpha, Netflix currently trades at a forward price to earnings multiple of 43.1. Now, the projected EPS that I told you of 37.94 and 31.30 is well into 29. You got to discount it to 27. So I've now discounted the EPS, projected EPS to 2027. And in scenario 3, that comes out to be 32.97, which means when you multiply 43.1 into 32.97, you get a price target of 1,421, which actually represents an upside of 29% from current levels. If you look at the baseline scenario, you have 31.30 as the projected EPS in 29. You discount it to 27. That comes out to be 27.20, the discounted EPS. 43.1 into 27.20 will give you a price target of 1,173, which only shows a 6% upside. So even from a valuation perspective, clearly investors have a higher upside. There is considerable upside from current levels should Netflix proceed with the acquisition of the streaming and studio business of Warner Brothers Discovery. Based on the caveat that scenario 3 becomes a reality, my rating on Netflix continues to be a buy. Okay, continues to be a buy with an potential upside of 29% if should the streaming division take place. Now, obviously, when I put a buy rating on a name, I give you the additional risk factors. Primary risk factor to my bull case is very simple. It's not Netflix walking away from the WB deal. It's actually rather it's the scenarios 1 or 2 play out, which is if Netflix acquires the whole of Warner Brothers Discovery, including the cable networks, very unlikely scenario, but could happen. Can't rule it out. Or worse, if it acquires the IP rights, which actually leads to EPS destruction. There is a 3-cent destruction in EPS. So if scenarios 1 or 2 play out, that would be my primary risk factor. While scenario 1 drives EPS growth, Netflix would have to take a significant debt to make the deal happen, which makes the risk reward very unfavorable to both the company and for the shareholders. The other risk is obviously the increasing competition that Netflix could have, especially if Paramount Sky does acquire Warner Brothers. 3 bids have already been rejected, as I told you earlier. But given the deep pockets of the Ellison family, the odds are certainly significant, in my opinion, for the merger with Paramount Sky to eventually happen, unless Netflix or even Amazon or other competitors make a significant competing bid. In the event that Netflix walks away from the bid, while there is still marginal upside to the stock price from current levels, the competitive landscape, in my opinion, would certainly become very, very different. Finally, if scenario 3 does materialize, in other words, if Netflix does acquire the rights of the studio and streaming business of Warner Brothers Discovery, then Netflix would have significantly boosted its leverage from current levels. We're talking about 3.2x leverage from 1.3. Should the synergies or other components that I showed you earlier in the waterfall analysis fail to materialize, then it would not only be a significant hit to the company's bottom line, but now Netflix and their shareholders would also have to deal with significantly higher debt levels. Bottom line, if one removes the headwind from the Brazilian tax dispute, Netflix had a relatively strong quarter. Strong revenues. Company saw double-digit revenue growth across most of its key markets. The company's content slate was once again very strong and highly successful, and with an even stronger content slate set for Q4, company is highly likely to return to strong growth in the very near future indeed. Moreover, the company's ads business is also trending in the right direction, and while still it's very early days, the ads business is very well positioned to be the company's next growth driver. In my view, the negative market reaction has less to do with the Brazilian tax dispute and more to do with the likelihood of Netflix getting dragged into a bidding war for Warner Brothers Discovery. Given that multiple reports have indicated that Netflix may make a play for WBD, I deployed a deterministic pro forma model with fundamental analysis to identify the scenario that is best suited for Netflix and its investors. Of the 4 possible scenarios that I took you through, the model identified that acquired Warner Brothers Discovery's studio and streaming business would provide the highest incremental EPS gain for Netflix, which is plus 6.64 by FY29. From a valuation perspective, there is marginal upside from current levels, even if Netflix does nothing. However, given the strong tailwinds, even by doing nothing, Netflix remains a name that should, in my view, be bought on any pullback. Having said that, should Netflix acquire the studios and streaming assets of WBD, then investors could see a potential 30% upside from current levels. Taking all of this together, I'm maintaining my buy rating on the name. Netflix, ladies and gentlemen, continues to remain the king of streaming. The Brazilian tax dispute is not going to change that, in my opinion. However, Warner Brothers Discovery studio and streaming assets have the potential to be very strong knights who could ensure that no one dethrones the king in the years to come. That's all the time I have for you this week. If you have a US-specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. See you next week with more information, more market insights. Until then, stay safe and make some money.